Audio Trade. This is Don Kaufman. December 3rd, 2021. We are just minutes after the cash close here on this Friday afternoon. I don't care who you are. I don't care how long you've traded. That was a volatile week and has got everybody asking the question, has the great market unwind begun? We're going to answer that and much more here on this weekend's update. Let's actually start with why we're kind of questioning, is this going to be the big one? It has everything to do right now with mega market caps that are in effect taking a hit. And we're going to look at some of those mega market caps here momentarily. Before I do that, just to kind of recap a little bit of some of the price action in the major index products. I mean, typically we look at the S&Ps, right? We look at the NASDAQ, we look at the Russell, okay? But let's start with the SPX, because one thing that really begs to be discussed is in sheer magnitude of the move. I mean, the SPX was pricing in plus or minus approximately 155 point move, okay? And that's higher or lower throughout the course of this week. Did we get there? And the answer is absolutely not. Now, we saw some wicked ranges, but net, in trying to kind of discern are we in like full-fledged volatility? No question, things got downright hostile during different portions of this week to the sell side. But again, to kind of quantify, I mean, people, we're nowhere near. I mean, the lower edge of the expected move was roughly 44, 41. Okay. How close did we come to that? Well, here, look, we hit 4,500. We danced around the idea of breaking lower, still almost 60 handles off what could have been an absolutely, just disastrous kind of week. But I'm going to caution you because volatility is just far from over. In fact, in just a few minutes, we're going to do a bit of a volatility update. So moving along, now let's look at the NASDAQ. Because the NASDAQ, completely different set of rules here. This actually did hit the lower edge of the expected move. But the interesting aspect of it is we actually closed on the lower edge of the expected move. Again, I'm going to come back to that and show you precisely why it's such an important aspect. Last, but definitely not least, look at the IWM. It too tagged the lower edge of the expected move. Time out! Why am I going through this? It's a display that whatever you might think about the volatility of this past week, it was all effectively priced in to the major index products. And before we even pin down, what the expected move is going to be the following week, and I'm going to do that here momentarily, to take a look at this at the SPX, do you realize, again, a week from now, put on your big boy pants, we're going to be looking at over 150 point move priced into markets yet again. And I think you have to fully anticipate we're going to see every ounce of it. Markets, there's a give and take relationship. They gave you, a whole lot of edge this week in the fact that we didn't make, that absolutely terrifying 155 point swing higher or lower, tagging the edge of the expected move. They didn't do it. And yet, we may have seen a rally here on this Friday afternoon. But the interesting thing in the rally is the SPX, its volatility for the next 7 days didn't really back off much. Push aside the volatility talk for the time being. Let's get right down to business. Mega market caps are taking a hit. Why should you care? Because how did we get here in the first place? And when I say how did we get here, let's just be very realistic. Open up, for instance, a 5-year chart inside of the QQQ. And all you can say when you look at a 5-year chart in the QQQ is, behold. When I'm talking about the great unwind of a marketplace, this is the place that you need to look first. And then you start to look at individual stocks like Google. Why? I mean, did you see Google versus, for instance, the QQQ? It's basically one and the same. Take a look at something like NVIDIA, which just rocketed, that last leg inside of the NASDAQ. Take a look at something like Tesla, okay, which again, there's just no question that, Tesla and Nvidia are instrumental in what has become just an, explosion to the upside. Now, take a look at their expected moves, okay? This is critically important. When it comes to Tesla, people are closed right to the edge of the expected move. The irony is that is indicative of an efficient marketplace. Take a look at, again, Nvidia, okay? When it comes to Nvidia, it only had a very mild down week. And you're like, okay, so where are you going with this, man? What I'm going with this is we haven't begun to hit our stride in terms of volatility, all right? Whether you look at Amazon, all right, whether you want to look at you want to look at Microsoft down nominally, okay? You got me on this one. Netflix broke down a little bit, but Netflix doesn't carry the market cap of the rest of these. Facebook, okay, Facebook had a fairly hideous week, but net, when you start looking at what's going to move this marketplace, whether it's Tesla, Nvidia, okay, go look at Google. Why is Google instrumental? Google had an unchanged week, massively unchanged. Do you realize this thing is still up 65% year-to-date basis? It's completely and utterly unscathed, okay? And you're looking at a marketplace and you're thinking to yourself, this is getting a little scary, okay? And the answer to you on that front is you ain't seen nothing yet. We haven't hit our stride in volatility, all right? And even when I discuss, okay, how big the expected move happens to be, I then countered and literally said we didn't get anywhere near the edge of the expected move. And even though we're going to talk about volatility, futures, and backwardation, we only just tagged the lower edge of expected move. But everywhere you look on the screen, things are going on the defensive. Jobs number was a huge miss. Yada, yada, yada. Nobody cared. I mean, listen, the market literally rallied off of the jobs number that was a miss. In fact, you take a look this morning right out of the gate, we started some sell side activity. But prior to that, when the jobs numbers came out, the jobs numbers actually initially spiked the markets a little bit higher in here. We were looking for over 550,000 jobs. Actual 210,000. Just depending upon what analyst you're listening to, they couldn't hit the broadside of a barn. Anyway, okay, the Fed throughout the course of this week nixes the term transitory completely and accelerates the taper, or at least adds that bit of language that they are likely to accelerate their taper. Okay, this right here, to me, is one of the most critical aspects, along with the fact that the mega market caps are starting to take a hit. So if markets are going to start to come apart at the seams, okay, it's going to be Google. It's going to be Tesla. It's going to be Nvidia, right? You're going to have to throw Microsoft under that bus as well. Why Microsoft? Again, on a percentage basis, all right? It's up some 50%. Why should I care about the percentage basis? Because it's dramatically outperforming the NASDAQ. You hit, okay, on a percentage basis, what has sustained some of the greatest recent gains. That's textbook institutional order flow, right? So you look at anything like in the QQQs, it's up 23%, all right? Should we hit Amazon? Well, no, that's only up 6% in a year. Should we hit Apple? It's up 25%. It's kind of in line. You look at Microsoft, they go, oh yeah, we can hit Microsoft, and ironically look at Microsoft. And yeah, it closed again to the lower edge of the expected move. But again, you have to see this shift coming. So the shift of the Fed nixes the word transitory immediately should change your entire perspective that ain't going to be no more free money. The Fed is now painted into a very interesting corner. The interesting corner is the jobs number could be a huge miss. The Fed, though, at this point has to start to be more concerned with inflationary pressures. And at some point, they have to basically say, like, that's it. We have to put the brakes on the economy, even though we might not be, technically full employment. What are we going to do? Well, we have to fight inflation. So you had to pick your battle if you're the Fed right now. You want to go after inflation because it doesn't matter whether you have a job or not. You're not going to be able to afford anything if they don't go after inflation. We'll worry about the jobs a little bit later. And I think they've actually picked their battle. And I think their battle is going to be on the inflationary side of it. Which actually brings me to the fact bonds moved, okay, kind of contrarian to that. The bonds started to rally and rally massively, okay, And you think about this and you're like, well, that's counterintuitive, because if the Fed is going to accelerate the taper and eventually raise interest rates, why are the bonds rallying? Because the bonds are actually pricing just that. The Fed starts to nix, the word transitory and so forth. They're going to cool the economy. You cool the economy, what do? Interest rates actually go down. Take a look at this, because again, it's counterintuitive, but net, look at that. Interest rates go down. Now, personally, I think this is a little bit oversold and we're probably due for a little bit of a bounce back. In fact, throughout the course of today's trading session, I actually put on a put spread inside of the TLT. Next! All right, so bonds go on the defensive, but I think that they're a little bit overdone, if you will, to the upside, and looking for a little bit of a pullback inside of the bonds. So as we start to discuss this great market unwind, there's just no question that, to me, a lot of this action is going to be sparked unequivocally by the Fed. They, again, it's free money forever. But at this point, we're going to have to contract some of that, trillions and trillions, $8 trillion of a Fed balance sheet eventually has to be contracted. So just that very notion changes, the scope of how individuals are going to trade. And that's where, again, if you want to know, over the next couple of days, is this really it? Is this the great market unwind? And I really think that that's the right phrase for it. Why do I call it the great market unwind? I call it the great market unwind because if you look at like the last 5 years, that's absolutely shocking. If you look at, for instance, 15 years, it's just awe-inspiring. Okay, this is back to the financial crisis. There's been a few downticks here and there. Okay, the COVID crash lasted a brief and fleeting moment. When you start looking, though, at a much longer duration chart and you look, at Fed policy, with this, you're going to be scared. And you should be at this point. You should have a little bit of fear because I think that's healthy. But again, a perspective here. You realize that today the S&Ps, down 43 points. At one point, they were down, all the way to 44.92, all right, which was, they closed a bit off the lows, if you will. The worst we saw today was a 1.5% move. And again, you have to recognize, the week prior, they were down like 120. To get to what we term statistical significance, you need a 3% or greater move. That's higher or lower. There's no question in the near term, maybe we're a little oversold and we get a bounce. But if you notice that every bounce lately is being sold into. The other aspect worth a mention right now, and this is for those of you that do trade some options, right? You start to look at some of the activity in options. Check this out. Now, I've been watching order flow day in and day out in a product like Tesla. The number of calls traded versus the number of puts. On a typical day, it usually trades 2 times the number of calls and puts. You forget the put-call ratio. It's useless. You have to look over here at the put sizzle, okay? It's actually trading more puts now than calls, which actually indicates that we can start to be in a degree of what they term a negative gamma squeeze. Negative gamma squeeze would be indicative of you start going out there buying enough puts and it'll literally start to force these stocks down. NVIDIA is almost at par, the number of calls traded versus puts. In fact, again, it screams in here. Look at this put sizzle. The put sizzle, what it means, it says 2.1. That means it's 2.1 times, all right, the normal daily option order flow versus what? The previous 5 days. Meaning this thing traded 2 times the number of puts. It's crazy, just crazy, because order flow right now has actually shifted to being negative. And this is going to drive sell-side activity. You wake up on a Monday morning and you start buying puts. People, you're going to shove that marketplace lower. Again, onward and upward. Now let's get to a little bit of a volatility update. In terms of volatility, it raged. Okay, volatility, we laughed, we cried, but the VIX actually did close above the 30 handle. And I'm going to tell you right now, if you look back at a chart here, even over like the last 3 years, you can pretty much count. You can count on one hand, really, the number of times that we've spiked above 30 outside of the COVID incident, if you will. But, and again, every single one of these spikes in volatility, back here was probably due to, something COVID related. But you start looking back even over 5 years. Okay. In fact, we'll even open up 15 years in here and you start seeing where the VIX closed. And again, should strike a little fear into your heart. Why? Because when else have we been a stone's throw off the all-time highs? We're already trading in a 30 VIX. Okay. Feel the fear, people. Moving on, onward and upward over there. Let's actually look at the volatility futures. The volatility futures crossed into backwardation, okay, and back again. And they actually, interestingly enough, here in the after hours, and I want to show you this, the 19-day volatility futures, okay, are currently at 28.55. Then we look out to the 47-day, they're at 28.35. We are, okay, in fact, in backwardation. In fact, I say they were in backwardation and back because what kept happening throughout the course of the day, this kept actually flipping back and forth. If you're unfamiliar with what this terminology means, okay, and by the way, there's a much more significant backwardation when you start looking at 47-day, okay, versus 75-day. What it effectively means, and I'm actually going to use right here these 47 days, okay, just put this into context. In the next 47 days, okay, we're looking at, again, 28.35, all right? But then you look out, just for example, 138 days, we're looking at roughly 27.80. What this basically means is right now, they're pricing more risk in the next 47 days than in the next 138 days. And if you think about that in context, you're like, well, this doesn't even make any sense. How could that possibly be? How could you say the world has a better chance of collapsing in the next 47 days than it does in the next 138 days? And that's actually the way to interpret it. That, okay, changes everything. That is very, very significant, okay, to the marketplace because it changes the nature to how firms hedge. At this point, if the short-term volatility futures continue to ascend, that means go up, okay? Trading firms are going to go out there and they're going to start selling S&P futures to mitigate their own volatility exposure. At that point, it's every man, woman, and child for themselves. And you actually saw degrees of that happening today. What I mean by that is like, how can I see that? That's when you start getting fast, precipitous drops inside of the S&Ps on an intraday basis. You know, contract spot size spiking to like 10,000. You know, lo and behold, if you missed this week, you know, I've been talking a lot about volume lately. Oh, it's raging. But the volume is nowhere near like capitulation kind of volume. You look back over like the last 3 years, you want to see capitulation type volume, you got to start getting to like 3.5 million contracts. All I'm saying here is people, we're just getting rocking right now. So vol futures crossed over to backwardation. It's on. That's what that means. When I say it's on, I mean get under your desk and start rocking back and forth because, again, you should take that really seriously. The VIX is over 30, confirming, okay, pretty serious nature of volatility. The VVIX, that's the volatility of the volatility index, is actually trading into Never Never Land. This is actually the highest close in the last 9 months. Taking a look back over like the last 5 years, this is actually one of the highest closes that we've seen in years, okay, on VVIX. Okay, everything right now points, all right, to extreme volatility. And by the way, yes, there were actually some trades that happened in the VVIX all the way back here. But, you know, you're talking about, again, the COVID crash, which is a pretty wild time. And, you know, I guess the thing is, when you start looking at this over the last 3 years and you're like, oh, look, Don, this closed at 209. Yeah, that's when the S&Ps also, okay, sold off like 5 to 6% in one night. That's the point that I'm trying to make. We were down 1% over here. What'd you do? It's like skinning your knee. We skinned our knee today, but we're priced for some really, really dramatic moves. Okay. Next thing on the docket over here, skew. Skew is still rocking. We haven't actually got the skew quote yet, but I expect skew to come down a little bit, not all that dramatically. And expected moves and IV ranks are absolutely exploding. For those of you that know exactly what I'm talking about with implied volatility ranking, the highest instances of implied volatility in the last 52 weeks are being seen literally right now. Look at the IWM, IV rank 99%. Look at the QQQ. Okay, inside of the Qs, what are we looking at? Volatility rank only 27%. That one is a little bit crazy, right? Start looking at like the spiders, volatility rank over 53%. We've seen some spikes in vol, okay, but anticipate, again, your volatility inside of the Qs could still come up and come up dramatically. All right, onward and upward from there. What does all of this really amount to? Okay, let's get into a little bit of strategy talk. Again, as I was showing you, though, the differentials between spider volatility and IWM and QQQ, most people don't necessarily like read volatility like that. Let me amount to this before I get into the strategy discussion. And I was talking about this a little bit earlier today on TheoTrade. Just bring up, for those of you that don't speak, Trader Geek, average true range, hit apply, hit OK, right? What I'm basically getting at over here is the ranges that you're going to see on a day-to-day basis inside of actual stock price movement are going to be huge by huge, and you're starting to actually see that right now. So ranges, and I think that this is going to continue to pick up. Take a looking at the spiders, right? Take a look at all the major indices out here. You can look at the IWM, which looks like it's about to fall off the edge of a cliff. So expect ever-increasing ranges. The other aspect that should really resonate with you is a day like today. The S&Ps were down 1%. You realize the advanced decline line was almost a pure 50-50. The AD line is not really great and representative, except how bad would this trading session have been if we had actually hit degrees of correlation with like 90 stocks down? All right, let's get to it. Strategy talk. Let's keep this short. Let's keep this sweet. Buying calls for rallies, you're going to get absolutely decimated. Okay, you need to understand this right here, right now. I don't care where you buy a call, okay? But if you buy a call thinking the market's going to rally, you realize that you're buying some extraordinarily high implied volatility. And the second we rally, they're going to crush the implied volatility. Retail is going to get their heads taken off trying to do that. So what you want to do is use spreads to offset volatility risk. And I'll just give you a quick example of what am I talking about? If you take a look at what's called Vega, Vega is an option sensitivity to changes in implied volatility. If you go out, okay, and you just buy an option, okay, for let's say, 584, you buy that option 584, you have 25 cents of Vega risk for every, 1 point move over here. So if we move from 30 down to, for instance, 29, you're going to lose 25 cents. But that vol crush is going to be huge by huge. When the vol crush comes, it's going to go from 30, knock that thing all the way down to 20. What are you going to lose? You're going to lose half your premium just for being you. There'd just be no way you're going to be able to make money. So what you want to do is you got to use spreads. You got to spread that risk. Why? Because you're buying like 25 Vega and, for instance, selling a 24 Vega. You'll take your volatility risk and completely compress it to absolutely nothing. You have to fight volatility risk or you die. That's bottom line. You go out there and buy calls because you think a rally is coming. You're already dead. I'm just the guy to actually have told you that. All right. Rallies are going to be baiting retail into devastating losses. It's another aspect that you better be aware of. There's a lot of dip buyers. They're not going to go down easy. There's just no question, and I'm not trying to be facetious in any way, shape, or form here, okay, that you need to take the volatility seriously, and this volatility is not necessarily going to abate overnight. Look at it, okay? This is something I've been talking about now for months, that when we finally do start to unwind, the unwind is not going to be like an orderly move to the downside, like the little stair stepper to the downside. We're going to get wild down, wicked bounces up. That's volatility, people. Like, if you came in here on Monday and saw the S&Ps up 40 handles, you should actually be nervous, because I'll tell you, people are going to jump on that and they're going to get absolutely devastated, all right? The sell side activity is not going to abate overnight. It doesn't matter what the outcome is. Maybe the outcome is the S&Ps, Don, are at 5,000. I've seen that movie before. In the very near term, though, if you're a dip buyer, okay, you cannot get drawn out. Getting drawn out is wicked sell-offs over here. You come in, you step in, you buy, and we just go down further. Or we actually bounce, and then we actually reverse on an intraday basis. I am telling you right now, this market that we are in this week has been phenomenal at baiting retail. I mean, literally out of the gate, all right, bid to the open, there's retail, and nothing but sell side thereafter. I'm telling you, it's just going to be absolutely devastating. Do not get yourself baited by markets. And if you're going to go directional, spreads for directional bias, use spreads. I don't care whether you want to be bullish or whether you want to be bearish. Okay, listen, do I have bearish positions on? Yeah, I do. Right? But I'm selling a lot of premium right now. I don't care how directional you want to be. You use spreads. If you don't define risk, you're going to die trying, right? You're going to be just, again, devastating losses. If you want to buy stock, this ain't the time, right? You buy stock, there's got to be some blood on the streets. And I'll tell you right now, when you have an advanced decline line that's like 50-50, okay, when you have stocks that are stone's throw off the all-time high, don't you dare think to yourself like, this is the greatest opportunity of my life. And then you realize Google's up almost 70% on a year-to-date basis. Okay? Spreads for directional bias. Lastly over here, premium sellers, start your engines. Oh, it's good. Premium selling doesn't get much better than this. Why? You realize you have over a 30 VIX with a skew that is just phenomenal. You're like, I don't even know what that means. You want to see exactly what it means. Here, look, let's go to the spiders. Okay? Last portion of this, and then we're just going to talk a little about the SPX. I promise. I want you to go to the spiders, and I'm going to open up an option that's just 77 days out. I know it's a little far out in time, okay, but this is what ultimate, and premium selling is really about. Look how far out of the money I am. I just want to make a point, okay? Yeah, the spiders, Don, are at what? What? They're at 450. You realize the 260 puts, 77 days out, they're still trading for $1. You're like, how? And I know this is like, a 2 delta over here, but how could this even be? Like, how are they trading for that? Look at the skew, the implied volatility. They're trading at a 62.8 vol. Huge by huge. I'm not indicating you're going to sell this one, but do you realize the kind of premium that's packed into this marketplace right now? And that's where people go, oh, this is not free money. It's not free money. But I'll tell you right now that the S&Ps, they would have to get devastated. Devastated. We're talking like 40%, type moves to the downside to even tag, and all you want to do is go out there and sell premium. Premium sellers, start your engines, because it is on right now. This is a great time to be able to sell some premium. Last but definitely not least, let's come over to the SPX. By the way, speaking of premium selling, I added to some of my inventory. This is just a smaller position here. I'm up to about $227 on that particular position. If you actually look over here at Tasty, you look at my Tasty account, I'm loading up on Theta. One account's got, this is just one position, has about $157 Theta. So I'm pushing upwards of about, between all the accounts, just under $1,000 of Theta a day right now, because this is the time to sell premium. All right, as I said, last but definitely not least, let's come over to the SPX, the mother of all products. I haven't drawn the expected moves yet. That's because the expected move, where did it settle out? 157.12, okay? 157.12. Behold, because I'm going to tell you right now, that is huge. As I said to begin with, put on your big boy pants. The expected move is even larger. It didn't matter that we rallied into the close. No one cared. Okay, we still ended up in backwardation of the vol futures, 157. $157 expected move. You realize we're closing at like what? 45.38. That kind of move. Where's it taking us down to? Deep into ugly territory at this point in time. You got to think like 4,400. But at the same coin with that, you got to think like, or we could be at all-time highs. Understand, volatility is here. This doesn't abate overnight. Okay? Define your risk if you're going to be directional. If you're going to sell premium, all right, do it with a soft hand. Volatility is not going to go away anytime soon. Understand that you're going to get, again, phenomenal opportunities. Has the great, market unwind begun? Yeah, I believe so. I think we actually are seeing the beginnings of an unwind in the marketplace. But this marketplace, okay, mark my words, this is not going to go into the night softly. This is going to be a fight, and that's why I believe that this is going to be baiting retail clients into devastating losses. Define your risk if you're going to be directional. Use spreads if you're going to try, to get bullish and catch one of these bounces, okay? And again, premium sellers, start your engines. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.